Hello to all of our viewers. My name is David McGann. I'm a director here at BMO InvestorLine, and I'm thrilled to be co-hosting today's webinar on understanding and trading single-legged options. This comes to you as part of our webinar series that really unpacks options trading. If you're newer to options trading, I highly recommend you check out our kickoff webinar, which was titled Getting Started with Options, if you haven't already. Once again, we'll be joined today with our friends at OptionsPlay, and I'm pleased to introduce Tony Zhang. Tony is Chief Strategist at OptionsPlay, where he leads development of options trading products, education for investors, and oversees the firm's quantitative options research. He's a frequent contributor to CNBC for analysis on the markets, with a specific lens using technical analysis, fundamentals, and of course, options. We're pleased to have Tony back. I know we have some great content to review today on understanding and trading single-leg options. And with that, Tony, I'll hand things over to you.
Thank you so much, Dave, and thank you everyone for joining here today. As David said, today what we're going to cover is understanding trading single-legged options, which from my perspective is one of the most important topics, especially if you are starting out with your options trading, but even if you are an experienced trading and you're trading other types of strategies. What we're going to discuss here today is really the fundamental building blocks of all option strategies. Whether you just trade single legs in your portfolio or you want to graduate to trading more complex multi-leg strategies, these are the foundational building blocks that you need to understand in order to effectively trade those more complex strategies. So today what we're going to do is we're going to break down the 4 core strategies, understand when you might want to utilize them, what the risks are, and the outlooks as to when you might want to trade these strategies. So let's go ahead and get started. Now, before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during our presentation today. So let's review what we're going to cover during today's session. First, we're going to kick off by helping you understand the 4 basic strategies of an options contract. An options contract can either be for a call or a put, and there can be a buyer or a seller for both of those contracts. So we're going to review what those contracts obligate or give you the right to do before we dive into the difference between buying and selling calls and puts. And we're going to go through examples because I always feel the best way to learn is by going through an example, and we're going to look at through each one of these examples when you might want to consider utilizing one of these 4 strategies, what the risks and trade-offs and potential rewards are for each of these strategies. And at the very end, we'll look at how you can apply these best practices to leverage them for more advanced strategies. So let's kick off by talking a little bit about stock trading, because I think before we can analyze each of these option strategies and when we might want to use it, let's first look at something that you as a viewer might be familiar with, which is trading stocks. Now, when we look at stocks, you really have 2 possible options. You can either buy the stock because you believe that the stock is going to appreciate in value in the future and you're bullish on the stock, or you can potentially short sell the stock because you believe that the outlook of the underlying security is bearish and you believe that it's going to decline in value. Now, if you look at these 2 types of strategies, you will have immediate gains if you get the directional view correct, meaning if you buy a stock and the stock moves up even by a single penny, you'll be profitable on that trade, and vice versa on the short side. Now, this is what we call symmetrical exposure, and it's incredibly easy to calculate how much your potential gains or losses are going to be depending on where the stock will be in the future, because you have dollar for dollar exposure based on the position that you have. So and the one thing that you have with equity investing or stock trading is the fact that you can buy or hold one of these positions for as long as you would like, as long as you have the margin to hold it on the short side, and as long as you have the cash or margin to hold it on the long side, you can hold on to it for as long as you wish. So the time horizon is set by you as the investor. So And the only limitation that I would say you have with stock trading is the fact that if you believe a stock is mostly going to trade sideways, it's not really going to appreciate or decline in value very much, there's not a lot of options for you to trade that particular stock and potentially profit from it. If you believe that this stock is going to trade sideways, you really have to move on to the next stock that you believe is going to make a substantial move either to the upside or to the downside in order to be able to profit from it as a stock investor. So that hopefully helps set up how we're going to discuss options today with regards to understanding when you have a bullish or bearish view, when you might want to utilize each of the options strategies. So let's talk about option contracts, because options come in two types of contracts. You have calls and puts. Calls gives the buyer the right to buy the stock. Puts give the buyer the right to sell the stock at a specific price on or before the expiration date. And this could either be for an underlying stock, an ETF, an index, or potentially even a currency. Now, because you can either be a buyer or a seller of a call or a put, many times if you're first time trader of options, having 4 options versus the 2 that you have with a stock investor is sometimes a little overwhelming. So one of the things that I like to do to help beginners remember what type of strategy is which is doing a little trick of just using plus and minus and some basic multiplication to help us remember whether buying a call or buying a put or selling a call or selling a put is bullish or bearish. So what I like to do is simply assign a positive and negative number to what is intuitive. And then if we do some basic multiplication, we'll be able to quickly gather whether something is bullish or bearish. So when we think about calls and the right to buy, we think about that as bullish. So I like to assign that as a positive number. And then a put option is the right to sell. I think of that as bearish, so I assign that a negative number. And then when we also think about buying and selling, buying is typically a bullish, so I assign a positive, and selling is a negative, and I assign that a negative sign. So if you simply just do some multiplication, if you're looking to buy a call, that would multiply a positive and a positive. That still gives you a positive, and that would mean that you have a bullish strategy. And vice versa, if you were to sell a put, which is a negative and a negative, a negative multiplied by a negative is a positive. So that's how you also know a short put is also a bullish strategy. And vice versa, a long put and a short call, because you're multiplying a negative and a positive, ends up with a negative. Those are the two bearish strategies. So these are some of the simple ways that I like to look at kind of the 4 different option contracts and help you remember whether you're trading a bullish and bearish strategy. But once we actually dive into the real examples of each one of these 4 that we're going to review here today, it's a bit more nuanced than just calling them bullish or bearish. And that's what we're going to review today and make sure that you understand when you might want to use each one of these 4 strategies.
Tony, that's great. I'm going to jump in here for a minute, if you don't mind. That's great. I think it's great that we're talking about, the essentials and understanding the essential strategies. And some of this is a nice recap, actually, from our initial kickoff webinar on getting started with options. And before we go much further, we often hear just in general, options trading is risky, right? And you've just talked about 4 strategies here. And so, why is there this perception that options trading is risky?
The perception, I think, comes from the fact that there are a lot of options when it comes to trading options. And out of all of the options that are available to you, some of them can be incredibly risky, or you are risking either where the probability of loss is relatively high, or the dollar amount that you're risking is relatively high. And that's why it's really important for us to review all 4 examples and help you understand exactly what the risk profile of each one of these strategies entail, so that you can make the right choices for your portfolio and your risk tolerance, so that you are able to pick not only strategies, but also strikes and expirations that make sense for you and your risk profile, so that you stay in the right lane for you. There are a very, very wide variety of strategies that you can trade once you start combining these 4 strategies into more complex strategies. But actually, one of the things that I always think about options is actually a way to reduce risk. And that's actually what we're going to show you here today, is how you want to think about these strategies in terms of potentially providing you with the outcome that you're looking for while minimizing the risk to the downside if the outlook that you expect doesn't play out. So with that, let's jump right into it. Let's look at the first option strategy. We're going to look at a call option, and we're going to be looking at buying a call option. So like I said, the best way to always learn is to go through a real example. So what we're going to do is we're going to compare the two types of bullish strategies. We're going to compare a long call to a short put. So let's start with the long call here, and we're going to use Amazon as an example. And currently, when we're looking at this particular example, Amazon's trading just shy of $175. And what we're going to do is we're going to look at buying a $175 call for about $12.55. And remember, from our first session, each option contract represents 100 shares of the stock. So if an option contract is quoted at $12.55 per share, to trade that option contract is actually 100 times that, which is $1,255 would be the cost to you in order to buy a call option. Now, the risk profile of a call option, as you can see from your screen, is that the upside here is actually unlimited. Just like buying a stock, when you buy a stock, if the stock keeps moving higher and higher and higher, you will continue to make more and more profits as the stock keeps going higher and higher and higher. And what you get with a call option is the same risk profile to the upside, but if the stock was to decline, as a stock investor, you would also have dollar for dollar exposure to the downside. But in a call option, what you have is limited risk. And the risk is completely limited to how much you pay for that call option, which in this particular case is $12.55 per share, or $1,255 per contract. And this is the asymmetrical risk that many investors, when they're first starting out with options, are drawn to, because who doesn't want the ability to have unlimited upside but have limited downside if the directional view that you believe on the stock turns out to be incorrect? So when you think about a call option, this is a strategy that you want to take on if you believe that the value of the stock is going to increase in value in the future because you participate in the upside while your downside is fairly limited. But like I said, I think calling these strategies simply bullish is not doing it enough service. And there's a bit more nuance to that. And I think it's important for us to understand, based on where the stock heads in the future after you buy this call option, we're going to look at some examples and we're going to look at how they perform, because that's going to help you inform as to whether or not it makes sense to buy a call option when you are bullish on the underlying security, such as we are right now with Amazon in this example.
So Tony, we look, great overview on this one example. I'm going to jump in again if you don't mind. And you touched on this a little bit, break-even price and understanding the break-even price, and just from the standpoint of, if the stock is trading above my break-even price, should I be doing anything at that point?
Yeah, that's a great point. And so that's what we're actually going to discuss next on our next slide, is to go through the examples. And when we think about a call option, right, the most important thing to remember, in my opinion, is the fact that not only does the stock have to appreciate in value in order for you to be profitable, it actually has to go above your break-even point at expiration in order for this strategy to be profitable. So if we're paying $12.55 for a call option that has a strike price of $175, that means our break-even price is $187.55. And remember, the stock is currently trading at around $175. That means the stock has to appreciate about a $12.50 between now and the expiration date, just the break even, which actually means that you have to believe the stock is going to move beyond that 187.55 in order to really justify buying this call option. So that's why when the stock does go above your break-even price, there are a few things that you can do. One, you can simply let the call option expire, and you will be auto-exercised, and you would effectively own the stock at that 175 price minus plus the $12.55 that you've paid for the call option, and now you have 100 shares of Amazon stock. And if the stock keeps moving higher and higher and higher, you will continue to make profits. But if the stock were to decline, you would also suffer losses to the downside. But you have different options. If the stock does move above your break-even price, you can either hold it to expiration and have it exercised, Or what's actually more commonly done is that most options traders will actually simply close their option at expiration or close to expiration prior to expiration, because that would allow them to simply profit from the increase in value of the options contract, and they don't actually want to own 100 shares of Amazon or be exposed to Amazon after the expiration date. So it's actually far more common, or what's most commonly done, is that options traders will simply buy the option. If it appreciates in value in the future, they simply sell the option for a profit and move on without necessarily getting exposure to the underlying security. So, as I said before, just calling a call option bullish, in my opinion, is not particularly enough information, because from my perspective, as we said, if you buy a $175 call option, but you have to pay $12.55 for that call option, then the break-even price of your option, of your position, is actually $187.55. So like I said, the stock has to rally by about $12.50 between now and expiration just in order for you to break even, which means that you actually have to believe the stock is going to be above 187.55, maybe at 190, 195, in order to really justify buying that call option. Now, that's a pretty substantial rally from my perspective. Looking at the chart here, the stock has already moved quite a bit, and you have to believe the stock will continue moving in that same with that same momentum to the upside in order to justify buying that call option, which is why I typically say that a call option is really bullish by a certain amount, and that amount depends on how much premium you have to pay for the option. It heavily depends on what the premium of the option is. You have to factor that into your decision-making process. Then you have to believe the stock is going to move materially above your break-even price at expiration in order to justify buying that call option. So it's actually not very common, in my opinion, where you have a bullish view on a stock and it necessarily means that you should just outright buy that call option. And that's a really important lesson to learn, because a lot of times beginner traders, they'll buy a call option because they're bullish on a stock, and next thing they know, the stock has moved in the direction they expect it to, but it didn't move far enough to exceed the break-even price, and they end up losing money on the overall trade. And that's might be very disheartening first-time trade, where you get the directional view correct, but you actually lost money on the trade, and it's because of this this concept that you have to overcome the break-even price of a call option before you're profitable. And that is, in my opinion, the most important lesson to learn here before you start trading options with a call option.
So Tony, we hear a lot about things like time value and how time can work against long option holders. How does time value affect my long option? Am I getting ahead of us here, or is this the right time to maybe ask a question like that?
No, I think that's a fantastic question. It really it helps kind of understand why you have to overcome the break-even price in order to be profitable. So in this particular case, I bought a $175 call option for $12.55. Now, when we talk about time value, we're talking about the component of an option's value that's extrinsic value. And in this particular case, because this is an out-of-the-money call option, every dime that you pay for the call option is extrinsic value. And when we talk about time decay, the extrinsic value of your option will decay to zero at expiration. So as an option buyer, as a buyer of an option, the extrinsic value of your option will decay as you get closer and closer to expiration. And this is what's working against you as an option buyer. So the asymmetrical risk profile that looks so attractive for a lot of investors when they first learn about options, who doesn't want unlimited upside with limited downside? But that asymmetrical risk profile comes with the trade-off of time value always working against you. How much time value? In this particular case, $12.55 worth of it. And that means that between now and the expiration date, the stock has to overcome this $12.55 in order for you to break even. And this is what's always working against you as an option buyer. And that's really one of the most important aspects to understand, is that that is the trade-off that you're making with the asymmetrical risk profile that receive as a call buyer. So it's important to understand that time value is working against you as an options buyer. And this is something that if you don't grasp that concept initially, many times this is really where we find traders where they'll buy a call option expecting that they'll make a profit because the stock went up, but they ended up losing money on the trade because they lost that money to time value. So I think we'll also explore this a little bit more in our next example, where when we look at a short put.
Excellent. And so, you know, and it's, so, I mean, I think you touched on this already when we're on the last slide, Tony. And so we've got a couple of options when we're obviously in a profit with an options trade. We can sell that option immediately and just bag the profits on the option price itself. The other option we have, of course, is to exercise that option before expiry. You touched on already where it's a little bit more common for options traders to generally just sell the option for a profit and move on. Are you able to just maybe, you know, like expand on that a little bit? Why is that often the most common choice for options traders?
Yeah, absolutely. So there's a couple of things here, right? Just to answer your last question first, it's most common that traders close out an options contract prior to expiration is usually because they don't want to take on the obligation or even the right to own 100 shares of the underlying security. They just wanted exposure to the option contract, and they really have no interest in owning 100 shares or being short 100 shares of the underlying stock as a result of it, because now you have exposure to the stock beyond the expiration date. So that's really why most traders close out the trade prior to expiration. But to answer your question as to whether or not you want to choose to exercise your option before or on expiration, generally speaking, if you are to ever exercise an option, you want to do it at expiration. You don't want to do it prior to expiration. I talked about extrinsic value eroding as you get closer and closer to expiration. If you were to exercise an option prior to expiration, you effectively immediately lose the extrinsic value of the option, because that is what's embedded into the value of the option. If you exercise your option, you lose that extrinsic value, which is why if you ever want to get out of a trade prior to expiration, it's better to close your position rather than exercising it. If you want to exercise your option, you typically want to do that at expiration, because at that point, the value of your option has no extrinsic value, and you're not going to lose that because you've exercised that option.
Very helpful. Thank you.
Yeah, absolutely. So let's take a look at a short put. This is also classified as a bullish strategy, but I also feel that's not the most accurate description. It's a bit more nuanced than simply calling it a bullish strategy. And many times this is a strategy that especially beginners tend to overlook because the risk profile looks so daunting and so poor. So let's explore this as an example here. In this particular example, Amazon's trading just around that $174 level, about $1 lower than the previous example. So let's say we look at selling a put option here. And in the example here, that what we're doing is we're going out to the June expiration, and we're looking at selling the 165 puts. So a put option, that's about $9 below the current price of the stock. And by selling this put option that's below the current price, I'm collecting $6.30 in credit. So $6.30 per share, or $630 per contract. And what you receive with this is limited upside participation, meaning the most you can make when you sell any option is the premium that you collect. So $630 per contract is the maximum potential profit that you can potentially make when you sell a put option. Vice versa, the amount of risk that you're taking and the obligation that you're taking on when you sell a put option is, at least on the surface, looks quite substantial, because in this particular case, I'm collecting $6.30 by selling the 165 put. That means my break-even price here is $158.70. As long as the stock stays above 158.70, I will be profitable. But my maximum risk here is $15,000 and $15,870. Now, if you weigh $630 in potential reward with $15,000 worth of risk, that sounds like a really poor risk to reward ratio. But I think that when you look at that on the surface, while it looks poor, you have to remember, in order for you to lose $15,870, Amazon stock has to reach zero by the June expiration date. So you have to ask yourself, do I realistically believe that there is a shot that Amazon will be worth zero in, let's say, 2 months' time? And you might say, I believe that that probability is very low. I perhaps think the probability of the stock being at 160 or 150 is relatively low. And so you have to think about what is your true risk to reward based on where you think the stock can realistically trade within the time frame of your expiration date. And that's really something that when you look at those risk to reward ratios, they look far more favorable than the technical risk reward of $630 versus the $15,000 that you're potentially risking in this particular case. But the one thing to remember, that when you're selling a put option gives the buyer the obligation, the right to sell the stock, which gives the seller of the put option the obligation to buy the stock from the buyer of the put option if that buyer chooses to exercise the put. So what that means is that if you were to sell a 165 put and the stock trades below 165 at expiration, you are effectively obligated to buy the stock at 165. But remember, you collected $6.30 worth of credits to take on that obligation, which means that if the stock does decline below 165 at that expiration date, and you are obligated to purchase 100 shares of that stock, the $6.30 that you collect is actually a discount to that stock purchase, which means that your effective net price on that stock purchase is going to be about $158.70. So when you think about a short put, it is a bullish strategy and it gives you the obligation to buy the stock. But the risk to reward ratio on the surface might not look particularly strong, but you do get a discount if you do end up with the obligation of owning that stock. And that is a really important feature of selling a short put, in my opinion. And we're going to look through an example of this in order to better understand when you might want to sell a short put.
That's excellent, Tony. And I know that we have a number of viewers on today that might actually, use just that kind of a strategy to continuously sell like a put option, with the idea being of hopefully they have to actually, buy that stock. And so, but of course, like you said, at a discount. Let's talk about the flip side scenario. Like, I know you touched on this a little bit, Tony, when you said, well, what are the probabilities of Amazon going to zero, right, in a matter of a couple of months? And we know that's pretty slim. But nonetheless, like it could continue to obviously climb. And so, in that kind of a situation, how are traders that are actually selling this put, like how are they going to react to that typically? What should they expect? What should they consider? Anything to expand on there?
Yeah, really great question. So, when you sell a put option, like I said, the maximum potential profit on the trade is going to be limited to the credit that you receive on the short put, which in this particular case is $630 per contract. Now, if let's say you sell this put option and the stock starts to appreciate in value fairly significantly after you sell the put option, the value of that put option will start to decline. And when you're a seller of an option, you want the value of that option to decline. So if let's say the stock were to rally $10, $15, $20, the value of that option will quickly erode from $6 maybe down to $1 or maybe even below $1. And that gives you the opportunity to buy back that put option for, let's say, $1, collect the profits between the $6.30 that you've sold it for and the $1 that you have to purchase that obligation back with. And what you can do is you can choose to sell another call option. Maybe you might want to adjust the strike prices higher because the stock has now appreciated in value, but you typically might want to sell another short put and collect more premium. And just to keep in mind that, what you have to think about is how much premium are you collecting, in this particular case, $6.30, versus how much cash do you have to set aside in order to sell that put, which is roughly a little over $15,000. And you can calculate the yields on that. How much yield are you collecting in the 2 months between now and expiration? And you might be surprised at how much yield you're actually collecting in that particular case, especially if you compare it to yields that you might get on the dividend or the yields that you might get somewhere else in a savings account or a bond. You might, even though the risk profiles of those are not the same, you might be surprised at how much yield you can collect by such strategies such as a short put, especially as the stock appreciates in value and you actually never own that particular stock. You're just selling that put option for the income. So let's flesh out this short put here a little bit further, right? So in this particular chart, what we have is the stock trading around that 174 level, that where we sold the 165 put and we collected $6.30. And what you see here is that the break-even price here is around 158.70. And that means that even though I'm bullish on this particular stock, in this particular case, by selling a put option and I'm collecting premium, I basically have a buffer on this bullish view. And what that means is that if the stock stays around 174, I'm going to collect $6.30 and make the full profit. But even if the stock were to decline in value, even if it declines to, let's say, 160, that's the stock decline from where it's trading today, but I'm actually still profitable on the trade. So this is really a fairly forgiving strategy. It's a strategy that naturally has a higher probability of profit, greater than 50%, because even if the stock stays where it is, if it increases in value, or even if it decreases in value a little, all three scenarios, I will be profitable. The only time I'm unprofitable by selling a short put is if the stock were to decline significantly below 158.70. That's when I will start taking on losses for this particular trade. And a lot of times, like I said, when you look at that risk profile, it looks quite daunting in terms of why would you take on $630 worth of credits in exchange for $15,000 worth of risk. But remember, as an equity investor, when you buy 100 shares of the stock, you are taking on $16,000 worth of $16,500 worth of risk if you were to buy 100 shares of the stock at 165. Here, you basically have the same obligation as someone who's buying the stock at 165, but you get to effectively own the stock at 158.70. So that $6.30 gives you a discount on the stock purchase. So if you compare selling a put option versus outright buying the stock at 165, you're actually taking on a $6.30 discount on your stock purchase, which is going to give you some downside protection. So, as we kind of review these two strategies, buying a call versus selling a put, buying a call option requires the stock to make a big move to the upside before you're profitable. So your natural probability of profit on that is relatively low. The stock has to move a big amount before you're profitable. When you're selling a put option, not only you're profitable, the stock does move in the direction you expect it to, but even if the stock doesn't move at all or even declines a little bit, in all three scenarios, you're going to be profitable. So you actually have a probability of profit that's greater than 50% when you're selling a put option, even though technically it's a bullish strategy. So even though both of these strategies are considered classified as bullish, they're quite different and they're nuanced, like I said, and it's really important for traders who are starting out to really understand these two characteristics, how they're different, how the risk profiles are different, and when you might want to utilize one or the other. Generally speaking, you only want to buy a call option if you believe the stock is going to make a big move in the direction that you expect it to, and generally you might want to sell a put option if, let's say, you're more neutral but longer term bullish on an underlying security. Now that we've kind of understood the bullish side by looking at a long call and a short put, now let's look at a long put and a short call, which, if you look at these two examples, is really just going to be a mirror image of the first two that we looked at. But we're flipping bullish now to looking at bearish strategies. And this is really something that's also interesting about options trading, because when you are a stock investor, generally speaking, a lot of stocks that you might be bearish on, you're probably not necessarily going to outright and short sell the stock. One, because it might be short selling a stock itself has unlimited risk. That's a risk risk profile that many traders might not be comfortable taking. You may not have the margin account in order to short the stock, and shorting a stock, not all stocks you can borrow in order to short. However, you might find that it's more palatable to look at buying a put option if you do have a bearish view. And a put option, just like a long call option, is basically the mirror image of it. So let's look at an example here of Amazon trading at around 175. And we're looking at buying a 170 put option, a put option that's just slightly out of the money option. And we're paying, in this particular case, $8.05 for that put option, which means my risk is limited to $8.05 or $805 per contract. And it gives me substantial reward to the downside. In this particular case, $161.95 per share, or $16,195 worth of maximum reward. Now, again, this risk profile looks very attractive. $805 in exchange for potentially $16,000 of potential reward. But we have to remember, in order to make that maximum reward, Amazon stock has to be at zero by expiration date, which fairly unlikely. Possible, but fairly unlikely. So we always have to take some of these risk to reward numbers with a little bit of grain of salt and put reality around where we believe the stock is going to potentially be, and then recalculate the actual risk to reward to help us better understand whether the risk to reward is favorable to us or not. But just like a call option, when we think about buying any option contracts, we have to understand the break-even price of that option contract. In this particular case, if we're buying a 170 put and we're paying $8.05 for it, our break-even cost here is $161.95. We're basically subtracting $8.05 from the $170 strike price. And if you consider the fact that the stock's currently trading at 175, that means the stock has to decline, in this particular case, nearly $13, or a little over $13, before you're going to be profitable on this particular trade. So you have to really think about the fact that even though this is classified as a bearish strategy, how far does the stock need to move in order for you to be profitable? Because that is the decision that is the question that you have to ask yourself before you just simply decide to buy a put option simply because you're bearish on an underlying stock. So in our example here, when the stock's trading at 174, as you can see where the stock is trading right now, our break-even price of 161.95 is denoted by the purple line on your screen. You have to believe that the stock is going to decline below that purple line in order for it to make sense to buy a put option. So if you believe the stock is going to decline by, let's say, $10, right? Maybe you believe that it's going to fill that gap, but maybe it's just going to trade towards the bottom end of the gap up here, which is maybe $10 lower than where it is. If you were to buy that put option and the stock ends up near the bottom end of that trading range at expiration, because you are above your break-even price, even though you got the directional view correct, you're still going to be unprofitable on the put option that you purchased. And again, that is a lesson that is learned the hard way by a lot of traders when they first start out, if they don't properly understand this concept when they first start learning how to trade options. So it's really important for me to reiterate that just classifying a long put option or buying a put option as bearish is just not accurate enough. It really has to decline by a certain amount, and the only way to understand that is by calculating the break-even price and asking yourself, do I believe that the stock will be below the break-even price at expiration? If I do believe so, then it might make sense to buy that put option. If you don't, then you definitely do not want to buy that put option, in my opinion, because that could lead to a pretty poor result where you get the directional view correct, but you actually lose money on the trade. And because of how far the stock has to move in this particular example, before you're profitable, the probability of profit on this particular trade is less than 50%, because even if the stock were to decline and move in the direction you expected, you can still lose money. The probability of profit many times on these types of trades is maybe in the 30 to 40%, sometimes even lower. So you really have to understand that concept before you venture into buying calls and buying puts. And lastly, let's take a look at selling a call option, which is going to be a mirror image of selling a put option. But there are some unique differences between selling a call or a put. So before I jump into selling a short call, I do want to just clarify that in the example that we're going to talk about here today, we're really talking about selling a naked call, which is not a strategy that's very commonly traded, but it is a fundamental building block of option strategies. So we are going to cover it at least from a conceptual perspective, so you understand what selling a naked call entails, what the risk and rewards look like, so that you can make informed decisions as you perhaps explore more complex strategies, how you can use a short call in combination with other strategies to give you some of the risk profiles of a short call without necessarily some of the risk. Okay, but let's first talk about what selling a call option looks like, or a naked call option looks like, which falls under the bearish category of strategies. But like I said, just calling it bearish, not quite sufficient. I think we really have to look at the true risk profile to better understand that. So in our example, Amazon at the time was trading just around that 175 price again. And let's say we look at selling a $175 strike call option. So a call option that's roughly the same price as the current price of the stock. And in this example, we're going to collect $12.35 on selling that call option. Now, here's the thing about selling a call option. Because selling a call option obligates you to short the stock at that 175 price, if the stock is above that price at expiration, you have truly unlimited risk. When you sell a call option, similar to short selling a stock, you truly have unlimited risk. If the stock keeps climbing higher and higher and higher, the higher the stock climbs, the more money you will lose. There's no limit as to how much money you can lose by selling a call option. Think about the short sellers of GameStop when the stock shot up from a few bucks to a few $100s, and the risk that they took on in order to do so. That is the same risk you would be exposing yourself when you short a stock, when you short a call option. So it's important to understand that your reward is limited to how much you can collect, in this particular case, $12.35, and your risk is truly unlimited. Now, you might say to yourself, I don't think Amazon stock is going to go to $300 by the expiration date, and that risk, and I don't not truly have unlimited risk, but it's important to understand that that is part of selling a call option. So just like selling a put option, because when you collect premium, that acts as a buffer against the losses to, in this particular case, to the upside. So when I sell the $175 call option for $12.35, my break-even price is going to be $187.35. Remember, I'm bearish on the stock. The stock's trading around 175, and my break-even price is $187.35. And then we're going to explore that here in 1 minute, looking at the different outcomes as to what that's going to look like by selling the short call option.
So Tony, you've touched on this a little bit, but I think this is worth a little bit of a double click, because you've mentioned and referenced unlimited risk with the strategy a few times, right? And I think for some of our viewers, like, just that might jump out and be a little bit concerning. So can you elaborate a little bit more? Like, why would an options trader ever want to entertain the idea of taking on a trade that involves unlimited risk? Can you unpack that a little bit for our viewers, please?
Yeah, absolutely. I mean, in terms of when you would ever sell a naked call like this, you really would do it when you have a truly bearish view on the underlying stock. You believe that the upside potential of the stock is very limited. You don't believe the stock is going to move materially higher from where it is today. And you do believe that it's going to either stay put where it is or decline in value. Both of those scenarios would play out. But like I said, not a lot of traders would outright short a naked call option because of the truly unlimited nature of this type of strategy. But when we look at a short put, a lot of traders think of short puts as similar to having unlimited risk, right? Because to lose $15,000 in exchange for $600 in the reward that we were looking at in our short put example, that still feels like you're taking on what feels like unlimited risk for what is a little amount of profit. And the question is, when would you ever do that? And I always tell investors that you have to reframe your thought process when you're selling a short put, because when you sell a short put, you're taking on the obligations to buy the stock. So you can either buy the stock outright at the current price, or you can look at selling a put option. And when you compare those two strategies side by side, you realize that every single time you sell a short put, you will actually come out ahead than just the option, than the stock buyer, because you're always collecting premium. So that premium is always going to offset any losses that you have in the underlying stock position. So from my perspective, the risk reward ratio of option selling on the surface doesn't look particularly attractive, but when you look at the yield that you're collecting on that short put versus the obligation that you're taking on, you might find that the obligation you already were willing to accept, such as if you were willing to buy 100 shares of Amazon, then why not collect that premium and offset the cost of buying that Amazon with the premium that you collect? So it's really looking at how much premium you're collecting and whether or not that's going to help offset enough of the risk for you to be comfortable to take on that obligation. But like I said, selling a naked call, not many people do it. It is a strategy that's fairly limited use. But as we explore more complex strategies, you might like the risk profile of selling a short call. We're going to explore in future sessions how you can potentially sell a short call or have a similar risk profile of selling a short call without the truly unlimited risk nature.
Excellent. Well, we look forward to that. And I know we'll be bringing some more of those advanced strategies in subsequent webinars. That's wonderful. Thank you, Tony.
All right, so let's move on and let's take a look at selling this short call and how this plays out if Amazon stock were to decline or increase in value in the future. So when we sell a call option, we think about this as a bearish strategy. So this will be profitable if the stock were to decline in the future below the $175 strike price that we sold the call option for. But just like the short call, just like the short put, because we're collecting in this particular case $12.35 for selling that call option, that is the buffer that we basically have against losses if the stock moves in the adverse direction. So if the stock were to increase in value instead of decreasing in value, we actually have this $12.35 buffer against our losses, which means that the break-even price here, like I said before, is $187.35. So even if Amazon stock were to climb $5, $10, in both of these scenarios, despite the fact that the stock has moved in the opposite direction that we've expected to, this is still a strategy that's going to be profitable. And this is what's quite attractive for a lot of traders when they want to trade a directional view, is that they want to be able to profit if they are correct on the directional view, profit even if the stock doesn't move, and still profit even if the directional view is incorrect. And this is really what gives selling call options like this type of strategy a higher probability of profit than 50%. And that higher probability of profit is really what attracts a lot of traders to option selling strategies, and why they are willing to take on substantial amount of risk or unlimited amounts of risk is that higher probability of profit. So it's really important to understand this concept as an option seller, because it's going to help you better understand when you might want to utilize these strategies. And like I said, just calling a short call a bearish strategy is not doing it enough service. It's really far more nuanced than that. It's really important to understand when you can be profitable, when it's not profitable, because if the stock now exceeds above that 187.35, that is when the strategy starts to have losses. So if the stock reaches 190, 195, the further it goes, the more losses that you might have. But this is really where investors have to make a call, and they might say to themselves, there's no shot I believe the stock's going to be above 190, and I'm willing to take on maybe a couple of $100 worth of risk in exchange for the $1,200 worth of potential reward, because even if the stock lands at 190 at expiration, yes, I have some losses, but it's still fairly substantial relative to the amount that I'm collecting on this particular trade. And that's, that's the decision that you have to make for yourself as to how far do you think the stock can go. If I'm wrong on this trade and the stock does go above my break-even price, how far do I think it will go? How much risk is that to me versus how much potential reward can I make? And that's a decision-making process that you have to think through whenever you're an option seller and you take on the obligations and the risk of shorting that stock at 175. So with that, let's now review what we discussed during today's session. So we talked about bullish and bearish strategies by breaking down the two different option contracts, a call and a put, and looking at the buyer of a call and the buyer of a put and the seller of a call and the seller of a put. So let's look at bullish strategies when we expect that the stock is going to increase in value in the future. Well, the first strategy we looked at is buying a call option. It's important to remember that you only typically want to look at buying a call option when you believe that the stock is going to make a fairly significant move here to the upside, because it requires the stock to rally above the break-even price in order to be profitable. It does have limited risk, but the trade-off with that asymmetrical risk-reward ratio is the fact that you have a lower probability of profit. Vice versa, as a short seller of a put option, which also falls into the bullish category, this is a strategy with a higher probability of profit because the premium that you collect offsets the potential losses that you have on the trade, which is something that you would trade if, let's say, you have a long-term bullish view, but perhaps short-term neutral, even perhaps short-term slightly bearish view, you can be profitable by selling a short put. So what you're really trading off is that higher probability of success trade in exchange for higher risk versus the potential reward. And when we look at bearish strategies, this is really for stocks that you believe are going to decline in value. This is really just a mirror image of that. You buy a put option when you expect that the stock is going to decline fairly substantially because you have to overcome the break-even price in exchange for limited risk, but that comes off with the trade-off with lower probability of profit, and vice versa. As a call seller, you have a higher probability of profit, but the risk profile that you have in exchange for that is you have fairly limited potential with an exchange for unlimited loss potential if the stock were to increase in value substantially. So as you learned here today, even though there are 4 strategies that fall into bullish and bearish camps, it's a little bit more nuanced than simply bullish and bearish. It's important to understand those nuances to help you decide which strategy is best suited for you based on the outlook that you have on the underlying stock. And hopefully today we gave you a breakdown of each of these 4, and you have a clear understanding as to when you might want to utilize this. But this really is the foundation and the jumping off point that you will use going forward as you potentially look at combining these types of strategies into more complex strategies, where you can get a little bit of what I call the best of both worlds, where you can have the same higher probability of profit but not take on unlimited risk or the same type of substantial amount of risk. And those are some of the things that you'll be able to explore once you understand these foundations. So with that, thank you so much. I hope that this is helpful in giving you a better understanding of how to trade single leg strategies and building the foundations towards trading more complex and advanced strategies with options.
That's wonderful, Tony. Thank you very much. I think that was a wonderful overview of walking us through the 4 core strategies for trading single-legged options. And as you mentioned, right, there's pros and cons, and there's important nuances that as options traders, as investors, we all need to think about when we're going to delve into the world of options. But also, as you mentioned, a tremendous amount of flexibility. And as we do get into some more advanced strategies, of course, that opens up a lot of different opportunities for options traders and investors. And that actually lends nicely into what's going to be our next webinar topic. And so we look forward, Tony, to having you come back, and we look forward to having our viewers come back, as we're going to be delving into covered calls and talking about how to master the covered call trade. And I think in particular for a lot of our viewers that are a little bit more income focused, obviously the idea of covered calls is looking to generate that ongoing and consistent income. So that's going to be a wonderful webinar. So we look forward to having you back, Tony, and we encourage all of our viewers to come back and join us for that one as well. Big thank you once again, Tony, for today, and thank you to all of our viewers.